because his wife is a CPA and he has promised her. I imagine that's how you keep the marriage working. When tax day is over, they go on vacation. He also is a nationally recognized speaker, teaches classes at several local colleges, including my favorite, my alma mater, Metro State. And I am certain you will learn and be very well informed today listening to Peter's talk. So please help me welcome Peter Scott.
So what we woke up with the 1st of January of this year was a whole sea change in our wealth planning. This was due primarily to the American Taxpayer Relief Act, and then of course earlier the Affordable Care Act. And so we're going to start out talking about the impact of that and where that takes us. But what we experienced is a 24% increase in the federal income tax as a result of the American Taxpayer Relief Act, which I'll refer to as ATR. We also had a 59% increase potentially in the long-term capital gain rate. So what happened then, and of course the elimination for most people of the estate tax. So when we're looking at wealth transfer planning, the emphasis shifted from estate tax, because most Americans are not going to be subject to the estate tax, to income tax. And so just to review that, the Bush tax cuts for those under the ATR remained the same if their adjusted gross income was under the 400 for singles, 450 for married. You can see the trusts and estates threshold is $11,950. There appears to be within the tax laws an attack on those who are intending to use trusts as a vehicle for their planning. We'll talk a little bit about that as we move forward. However, for those people that are over those thresholds, the maximum rate went to 39.6%. You can see it's 39.6 for trusts at that lower threshold. Estate or long-term capital gain tax moved from 15% to 20%, and then qualified dividends interest over that threshold, when adjusted gross income is over that threshold, is taxed as ordinary income, so we don't get the break that we've been enjoying for the lower amounts. And I'm sure most of you know that the estate tax exclusion moved to $5,250,000. If it's a married couple, they have a combined rate of $10,500,000. Any amounts over that are taxed at 40%, which means that people dying in the United States, if a married couple's total assets under $10,500,000, they don't have an estate tax, and that includes most of us. And then, of course, the annual gift tax exemption was pegged to $14,000 this year. All of those are indexed for inflation as we go forward. The act that passed earlier, the Affordable Care Act, tacked on a Medicare surcharge of 3.8% on dividends, annuities, royalties, rents, profits from LLCs and S-corps if you're not actively involved, and capital gains. And those applied not at the 400,000 or the 450 threshold, but the lower amounts of 200 for individuals and 250,000 for married couples. The estate tax gets hit with that. I'm sorry, not the estate tax, but trusts and estates are hit with that additional Medicare surtax of 3.8% at $11,950. So we have also for wage earners, since remember in that list of items that the Medicare surtax of 3.8% applies to, did not list wages. Wages are taxed at an additional 0.9% for those people where their adjusted gross income is over those threshold amounts. So if we take a look at this, what impact do these two taxes have on our tax system? Ordinary income rates moved from 35% to as much as 43.4% this year and beyond. That applies also to the short-term capital gain tax. Long-term capital gain then moved from 15%, which we've been enjoying over the last number of years, to a high of 23.8%. We've got the 0.9% additional medical surtax on wages. And on top of all that, we've got our Colorado income tax of 4.63%. So what did this do? Well, these two acts really took us to the point where we were looking at refocusing our planning from an estate tax to really income tax planning as we're looking at the wealth transfer. And what that meant was we're looking at focusing on income tax basis moving forward through in terms of these planning techniques, and also minimizing the income tax, or I should say our income, below those threshold amounts. So what we want to do is keep our income under the 400, 450, more importantly maybe under the 200, 250. And the estate tax really is not an issue. A study done by the Urban Institute and Brookings Institute predicts that only 1/3 of 1% of the people in the United States are going to be subject to the estate tax. So it kind of took estate tax planning off the table for most of us, and now the real impact, at least for 99.67% of us, is income tax. So how do we approach that, and what do we do? Well, one of the things that we want to do is make sure our adjusted gross income remains under that Medicare surtax exemption of the 250, 200. We want to avoid spikes in income. Where do those occur? When someone sells their property, right? They'll have an income increase, and that's going to impact the adjusted gross income, may push them into those higher brackets, into that 3.8% additional tax, may move them into long-term capital gain rate of 20% plus the 3.8. So what are some of the techniques that we want to employ? And these are just some of them that I've picked out. And they fall into at least the 5 I've picked. We've got charitable remainder trust. We're using that in this context as an income tax sort of evening device so that we're spreading and avoiding the spike in the income tax from a sale of a piece of property. Bob Keebler has developed and is promoting what he calls a real estate reorganization, a new application for charitable lead trust that we haven't seen before, the deferred installment sale and the 1031, which you're all familiar with, I'm sure, but we're using that in an income tax environment. So let's take a look at a charitable remainder trust as we apply it here. Charitable remainder trust can help us eliminate the 3.8% Medicare surtax as well as keep that capital gain rate from increasing above the 15%. So this is a diagram of basically how it works. So in this context, let's assume that you're selling a piece of property and the sales proceeds or the profit that you're making from that sale is going to take your adjusted gross income and push you above the 200 or 250,000, subjecting you to a 3.8% additional tax on the amounts over that year, and may, in fact, if the gain is large enough, increase your capital gain tax by an additional 5%. So one of the ways to even out that and avoid that spike would be to contribute that property to a charitable remainder trust that you would create prior to the sale, and then the charitable remainder trust would sell the property. Now, is there a gain on the transaction? Yes, there is. But the charitable remainder trust is a charity, so it doesn't pay any gain. And so as a result, there's no income tax. So sometimes I refer to a charitable remainder trust as a capital gain bypass trust because it's more reflective, and especially for clients who may be a little resistive to the word charitable. And so that's contributed to the trust. The trust turns around and sells it, invests the proceeds, and then you, as the creator of that trust, get an income stream back from that trust. So you're getting your cash flow from that sale, but you're evening it out over the remainder of your life or a term of years if you want to run it something short of that. You can run it for your life, you and a spouse, you spouse children, all of that. So you can do that. So basically, this is what's called a split interest trust. And we'll come back and circle back on that when we look at planning for the 1/3 of 1% of the people in the U.S. that have an estate tax issue. So this income stream is paid back to you typically as a taxpayer. At the end of your life, let's say it's a lifetime trust, then what's left in that trust passes to charity. So the complaint is, well, wait a minute, I'm disinheriting my children. True, you are. However, with the increased cash flow, the charitable income tax deductions that you receive, you have money that you wouldn't have had before that you can use to purchase life insurance that may replace that inheritance that is going to the charity as opposed to the kids. So let's run through a quick example. Husband and wife, age 65. They have a choice. They can sell the land, and I'm assuming just for this example, because I'm not great with math, that their basis is zero. They sell it for $1 million. We have $1 million long-term capital gain. And they pay the tax on it and invest the difference and go on their way, or they can contribute it to a charitable remainder trust. So let's compare those side by side. Sale price of $1 million. On the left is if we sell the property in a taxable transaction. On the right side, we assume that we've used a charitable remainder trust. Cost basis is zero. Our gain is $1 million in both columns. However, the capital gain rate can be as high as 28.43%. So if it's a taxable transaction and you're above the thresholds, your net is $715,700. Whereas with the charitable remainder trust, the full $1 million proceeds are available for investment. So if we're able to get a 5% return on that money, if it's a taxable transaction, we're only making $35,800 or so, and that's our cash flow then from that investment. However, if we're able to invest the full $1 million at 5%, we've got $50,000 cash flow. That's a swing of almost 40% in our tax or cash flow. And in addition to that, by the way, I failed to mention, you also, or this hypothetical couple would also get a $337,240,000 income tax deduction as a charitable contribution, because remember, the charitable remainder trust is a charity. And that calculation is the present value of the estimated amount going to the charity at the end of their joint lives. And so that income tax deduction then can be applied against their other income, and they've got the cash flow that's 40% greater than they would have had from this taxable sale. As a consequence, there appears to be sufficient funds to purchase a life insurance policy, if they choose to replace that lost inheritance for their children. What this does is, in addition to that, because we've leveled out the income from this, we avoid exceeding those thresholds, so we don't hit the 3.8% Medicare surtax going forward. And in addition, we may be able to avoid the 5% increase in the long-term capital gain if our other income pushes us up into that level. So that's one version of it. When we're looking at this, then what we have is that evening out of the income, the avoidance of the Medicare surtax, potentially the avoidance of the additional capital gain, and we've got that cash flow. So that's one application of the charitable remainder trust that we really haven't looked at in the past because we've really been more focused on the estate tax. But that opens up that possibility. The other, or not the other, but the next one is this real estate reorganizations. Bob Keebler is a national commentator, CPA, in Green Bay, Wisconsin, and this is a technique that he's suggesting. It's not overly complicated, pretty straightforward, and it has to deal with self-rental. So in this case, for example, a self-rental would be if you own real estate, presumably in an LLC, and you had a business, and let's just say it's in an LLC, and your business is renting your real estate from you, not an uncommon practice. Under the Medicare surtax, that rent from the rental LLC, or sorry, from the operating company to the rental is subject to the 3.8% surtax. And so there's a very easy way to avoid that. This is a graph of how it would look. Single-member LLC, we have the two single-member LLCs, a lease between the two. Those lease payments, if you're above that threshold, are going to draw the 3.8% tax. By a simple transaction, that is forming a holding LLC, transferring those membership interests into the holding LLC, the operating LLC and the real estate LLC merge for income tax purposes into the holding LLC. The lease goes away for income tax purposes, and as a consequence, we don't have the 3.8% applying to rents in that situation. So that's another technique if you're looking at self-rentals. Charitable lead trusts are a different form of trust, similar to the charitable remainder trust, except that they're more of a mirror image of the charitable remainder trust. And the concept behind this is that when we're talking about those thresholds, the 200, 250, or the 400, 450, that's calculated on the basis of adjusted gross income, which is the number at the bottom of the first page of your tax return. Charitable deductions appear on Schedule A of your personal income tax return, which is brought forward on page 2 of the tax return. So the takeaway from that is that the charitable contributions do not reduce adjusted gross income. So you could effectively give away all of your income for that year and still be subject to the AGI over that threshold. So how do we then shift that so that we can get some benefit? So let's take a look at a charitable lead trust first. And what this sets up is the property goes into the lead trust, and unlike the charitable remainder trust, the income interest off of that property then is paid to a charity for a term of years. And at the end of that term of years, then the property comes back to either the taxpayer or passes to the next generation, depending on what your goal is. In this case, we're looking at an income tax sort of defense, and in this case, probably the property would come back to you at that point. So if we take a look at that, understanding that maybe we want to make a charitable donation of, let's say, $150,000 based on income generated by an asset. So if we had the income come into our on our tax return, we got $150,000 of income, and that increases our adjusted gross income by $150,000, even though we gave it away, may push us over the threshold, and we're above the 3.8%, or we're incurring the 3.8%. So if we take a look at that, on the left is the Section 170 charitable deduction, income tax deduction. That's what we as individuals, that's the section that we apply it under. So we have, say, $260,000 of wages. So I'm trying to push us above, for the example, above the 200 or 250 mark. $100,000 of interest income, $50,000 of dividend income. Our adjusted gross income is $410,000, clearly above the thresholds for the Medicare surtax. We deduct the $250 for our married couple. That leaves $150,000 of, $160,000 left over after that. So the 3.8% would apply to the lesser of the excess over the $250, or our net investment income, which is defined as interest, dividends, rent, annuities, those things I went through before. So the 3.8% is applied against the $150. We pay $5,700 of tax, even though that $150 went to a charity. However, if we take that same property that generated the $150, put it into a charitable lead trust on the right side, that falls under a different code section. So the charitable lead trust pays its own tax. It gets a dollar for dollar offset against income for that deduction. We zero out AGI, no 3.8%. So just by moving that property for a period of time into the charitable lead trust, we've kept ourselves below the threshold. That money was going to go to the charity anyway, and as a result, we save 3.8% tax on all of our income. So that's a use of the charitable lead trust. The other two, or at least the fourth suggestion, is a deferred installment sale. Now, we're very familiar with this. We sell a piece of property, we take back a promissory note, and everything is fine. But using this, if you have a cash transaction, you may be in a transaction where you're not real comfortable taking back a note with this particular purchaser. They're offering cash, and cash in the hand is always better. But if you do that, it's going to spike your income over and above the threshold amount of 200 or 250. So what we can do is we can take advantage of the Section 453 installment sale, where we can shelter up to $5 million of gain through that device, or $10 million if we're a married couple. There is a limit on the amount that you can shelter. Now, of course, you may have some depreciation recapture in the transaction, but that's going to be there regardless of whether it's deferred or not. So what we want to do is to grab that cash, but if we do, it's going to spike our income. What we want to do is level that out, but we want to take the cash. We really don't want to take back a note. So if we're thinking about this in advance of the sale of the property, then what we can do is we can sell that property to a related party. So an irrevocable trust that we create and set the terms up, or perhaps a relative, a child, would go ahead, we sell it to the child, take back a promissory note. Now, the promissory note does not have a due on sale provision. We've eliminated that, so it doesn't trigger the payoff of that note on sale. Remember, we're working with related parties here. And so the basis then for the child or the trust is what we sold the property for, correct? Presumably that's fair market value. However, if that child or the trust within 2 years following that sale turns around and sells that property for cash, then we have to recognize the full gain immediately. So what we want to do this is well in advance of the transaction. We're thinking about selling this property. We put it into this trust or we sell it to the child. They hold it for the 25 months and then turn around and sell it. And their gain is going to be measured by the purchase price they paid. And we're outside the 2 years. So in our example here, Dad sells it to the son, I've used in this example, and let's say it's a 20-year note, $200,000 per year. And so then Dad's under that radar, he's under the threshold of the 200 if single, 250 if married, so not incurring the 3.8% Medicare surtax. Son holds the property for 25 months and then sells to the third party for a cash transaction. Son recognizes gain on the difference between what he purchased the property from Dad for and what he sold it, presumably in 25 months, not a significant amount of gain. So son pays maybe a small tax, maybe none, depending on, and certainly doesn't push son up above the thresholds. Dad continues to receive the payments and evens out the income, the gain, to keep him below the 3.8%. And so Dad knows the money's there, it's already been received, but he doesn't have the constructive receipt because we waited beyond the 24 months, and then Dad is unable to survive that spike in his income and be able to even it out. Then the last one of the income tax techniques that we have is the like-kind exchange. Very familiar, done all the time. We're going to use it in the context of really trying to eliminate any spike and to reinvest that property, keep our adjusted gross income below the threshold. So if the intention is to keep the property invested, it makes sense to roll that over. It can be tax-free if done right. We could end up only investing part of it, so we may decide we want to take some of the gain, recognize that, keeping in mind we're going to keep our adjusted gross income under the threshold amounts. And it allows us to consolidate or diversify. We can relocate the investment. This is all very familiar. But the downside is, of course, we're not getting the step up in basis. Remember, when I'm talking about the income tax planning, we're focusing on two items. One is the income tax basis, so that when we sell it later, our gain is not going to be spiked, and also keeping the current income under the adjusted gross income threshold. Of course, there's additional transactional costs, and our equity has to be reemployed into the new property. The other parts of it in terms of requirements, simultaneous exchange, pretty straightforward. If you have a deferred exchange, and you know that we have to identify the replacement property within 45 days, and we have to close on that property that we've identified, or at least one of them, within 180 days of the close of the transaction, or if our tax return for that year is due earlier, that's the cutoff. So for an example, let's assume that this transaction occurs in November. We would have to close on that sale by April 15th of the following year, 5 months later, unless, of course, we file an extension on our tax return. That will push it out, and we fall under the 6-month rule and allows us to do that. However, if our purchaser, that is the person who acquired our relinquished property, or we sell the replacement property within 2 years of the transaction, then we all get to pay gain on it. So we want, again, that 2-year rule comes into place there. So we've got to keep that in mind, that we can't dispose of this property within 2 years. You can avoid the carryover basis on that too if you hold that property till death. We still have what's called a step up in basis, although since 2008 it's been more step down in basis. But the income tax basis at death then readjusts to the date of death value. So if there's a gain involved, then the income tax basis moves up to the date of death value as it passes to the heirs, and then they have a new basis, and they turn around and sell it. They don't have a gain, and consequently no spike. So that gets us through at least 5 of the techniques that we use for the, what should I say, the avoidance of the 3.8%, possibly the 5% additional capital gain, keep us under those higher thresholds. What about the other 1/3 of 1%, the people who are still up there above the $5.25 million or the $10.5 million? Well, there are a number of things that we can do. We're falling back on traditional planning here that we've been doing for years. Split interest trust is a very popular approach. We talked about that in the charitable remainder trust, charitable lead trust arena. So basically what it is, just reiterating that, we're taking a trust and we're dividing up the income interest from the remainder interest. Income interest would be the earnings, income generated by that trust for a period of time, the length of the term of the trust, and the remainder is what's left then passes to maybe another beneficiary. And we can use these to avoid, again, the spike, but in this context what we're using them for is to shift the value of the property and the estate to the next generation on a leverage basis, and still maybe retain income from that. Because when we're looking at this, we're not looking at minimizing the income tax, although that may be part of the overall plan. We have an estate, let's say $15 million. We know that we've got a threshold of $10.5 million, so anything over that is going to be subject to tax. I'm assuming a married couple in this example is going to be subject to tax at 40%. That's an estate tax that's implied at death. So the concept is that we want to reduce that estate below the 10.5. And so a lot of our clients, they're okay with reducing it, they just don't want to give up the property or give up control or perhaps give up the income. The split interest trusts allow us to perhaps do that and to get that threshold amount of the estate below the 10.5 in my example. Here are 3 split interest trusts that we've talked about, the charitable remainder trust and the charitable lead trust. I'm going to come back to those and talk about them more in the context of estate tax planning and less in the context of income tax planning. And the Grantor Retained Annuity Trust, otherwise known as a GRAT. So as we move through this, let's look at the Grantor Retained Annuity Trust. Now this is a form of trust that is established by the taxpayer, and they put the property or contribute the property into the trust. They take back an annuity based on the value of the property and the term of the trust. What that does is it reduces the value of the property going to the children in 5 years, 10 years, or whatever period of time. It's an actuarial calculation based on the value of the property, based on the term of the trust, and what's called the 75/20 rate, or the interest rate that's published by the IRS for discounting for present value calculations. So we may give away $100, but the value of that gift, because of the income and remainder interest, the income interest coming back to us is not a gift because we're receiving that. The remainder interest that may pass to the children then is the gift. So what's the present value of that gift? Well, we can run that calculation. Thanks to Sam Walton of Walmart fame, there is something called a Walton Grant. And what that calculation results in is a 0 gift to the children. IRS challenged that, said you can't do that. The court said, oh, yes, you can, and so it's become very popular. The Obama administration has had on its business plan The elimination of this particular technique, or I should say the restriction, they're saying that the grantor retained annuity trust must last at least 10 years. This technique, in order to get that zero gift, tends to be a little shorter than the 10 years. So this particular technique may not be around a whole lot longer. It kind of depends on what happens at the midterm election. So what we're doing is we're giving this property away. We're retaining the income interest from it, the annuity payment, and yet we're giving away this $100 and maybe counted as $40 or zero if we use the Walton technique. So we're eliminating that from the estate, and we're still getting our income interest on that technique. So it's a fixed annuity. It's usually expressed as a percentage, so maybe a 5%, 10%, 20% value of the income stream coming back. It's going to be effective for our estate planning, but we're going to have an asset that is going to be able to generate the amount of money that's necessary to pay that annuity. So it is limited. A lot of times cash investments are used in these transactions, or property that's appreciating rapidly. And the client has to want to intend for that property to pass to the children. So if the children are the remainder beneficiaries. And so all income and appreciation in excess of that annuity payment is then going to pass to the kids on a state tax-free basis. And so it's possible, given interest rates, given the economy and what's going on, to move substantial wealth to the next generation. In fact, what has come to be known as rolling grats, they're done on a short-term basis, 3-5 years maybe or less, and so we'll circulate that. So we put the money into the grat. The bulk of the funds may come back, but there's that little bit, 10-20%, that moves to the next generation. Turn around and do another one of those, and so over 4 or 5 of those, we move that entire asset out of their estate without any estate or gift tax whatsoever down to the next generation. And so those are possible to use, and they're really indicated where there's a significant income producing property, because if the property isn't going to produce the income, then we're left with carving off a part of that property, giving it back to the taxpayer. They may turn around and do the same thing. So those are possible, but generally we want something that's going to throw off some income. So if we have a client that wants to pass property and avoid the estate tax liability, there's sufficient of cash flow, and they want to avoid that, we can set this up, and it works quite well. And it's quite popular in the estate planning arena as moving that wealth to the next generation. The charitable remainder trust is the same the structure that we had before. We put property into the trust, and of course this works best with highly appreciated property because we're avoiding the capital gain tax on that sale of that property if we get the property in advance of that transaction. So we get that $370,000 charitable income tax deduction for setting this up. Trust turns around and sells their property, doesn't pay any tax on the transaction. The assets then are invested, and then at the taxpayer's death, that property is not included in their taxable estate. It's outside, it's a completed gift, and yet during that taxpayer's lifetime, they're getting that income distributed back to them. Is the income taxable? It is. So that income that they're receiving is going to be taxed. Typically, if it's a large capital gain, a lot of that will be coming back in as a capital gain. And remember, on the income tax side, we're leveling out the income. Here we're looking at it, getting it out of the estate, and yet retaining the cash flow and maybe a higher cash flow out of the proceeds of the sale. At the end of that term, then it passes to our charity. But then in this case, if we want to leave that money to our children or to replace it, we get a life insurance policy. But rather than us owning it individually, we're going to put it into an irrevocable life insurance trust. Why? Because we have an estate that's already subject to the estate tax. If we own that policy in our life, contrary to a lot of beliefs in the public, that is tax. The life insurance proceeds are subject to estate tax, not income tax, but estate tax. So let's say I have a $5 million policy and I have a $10 million estate, so I've gotten it down below the threshold. That $5 million of insurance proceeds is going to incur a 40% estate tax. If I can take that $5 million insurance policy, put it into an irrevocable life insurance trust, then at my death I don't own it, it's not included in my estate, and that $5 million passes to the kids estate tax-free and income tax-free both. So when we're looking at a taxable estate, we're going to be looking to get that life insurance policy out of the estate so it's not taxed within the estate on those taxable estates. So in this case, since we've gotten the property out of the estate by using the charitable remainder trust, we're looking for clients that are looking to sell the property at some point. They don't want to pay the capital gains tax on it, and so they also don't want to give up the income from that. They may need that or want that, and they want to benefit a charitable organization. Now, we can demonstrate how benefiting the charity will benefit the taxpayer. Remember, in our income tax example, we showed that there was a 40% increase in the cash flow from the property by not paying tax on the proceeds of the sale and investing those. So there is a non-charitable motivation, but if there's a charitable inclination here, it's very helpful in terms of moving this forward and the clients being receptive to it. The charitable lead trust is, in this context, I talked about earlier using a charitable lead trust during lifetime. This use of the charitable lead trust is a death application. So what we're going to do is we're going to set this up at death, not during lifetime, because what we're trying to do is move assets out of the estate so that they avoid the estate tax in this application. So same sort of structure, except that the taxpayer's property comes into the charitable lead trust at death. By the way, this is a technique that Jackie Onassis had in her estate plan, which, by the way, is public record because she used a will. And so we can all go look at that if you're interested. But she provided that she had done certain tax planning. She had reduced the tax in her estate down to a certain level, and then she employed this charitable lead trust to soak up the additional tax. So the formula that was in her will said, at my death, whatever is left that is subject to the estate tax, I want to take, put it into a charitable lead trust that has these characteristics. And for a period of time, based on the percentage rate that's applied at the time of her death, I want that income to go to the charity. It worked out to be about 10 to 15 years. And then at the end of that time, that property passes to my children. By using the 10 to 15 years, the value of that gift calculated actuarially to the children was zero. She avoided the entire estate tax by doing that, and it's a technique we use very often. Sometimes these are called deferred inheritance trusts because the children are deferring their inheritance for a period of time to avoid the 40% estate tax. And so they can be used, and we use them frequently where we have an estate where we've done all of our planning, we've gotten the estate down as low as we can, but we still are above that threshold, and the client doesn't want to employ the other techniques that would cause it to be brought down. We can put this into their estate plan, soak up that additional estate tax, and their children get the property a little later in time. These are particularly effective because of the leverage when the interest rates are low. This is an ideal environment for this particular technique. They have less leverage as the interest rates increase. So if we go through a period of time, which I think we'll face eventually, where interest rates are going to climb, this will not have quite as much attraction, and that length of time for the kids to get it may extend a bit more to the 15-year rather than the 10-year time frame. So when we're looking at this, we're looking at this strategy if the taxpayer wants to, in a lifetime application that we used in the first part of the presentation, if we want to use it for the charitable deductions, we want to accelerate a charitable deduction because the contribution to the charitable lead trust during life gets a charitable income tax deduction from that. But remember, when we used it on the income tax side, we're trying to shift the income tax deduction for the contribution to charity to the trust where we don't get a bump in the AGI as a result of not being able to deduct the charitable contribution. However, in this context, for the 1/3 of 1%, we want to discount the value of that property in the estate. We can go all the way to zero, or we can have a value that we're willing to accept. and then that property then passes to the children without any estate tax or with minimal estate tax. So that's a different application for the charitable lead trust, charitable remainder trust in the split interest trust concept. The other and last technique that I want to share with you regarding these taxable estates is more of a freezing technique. And what I mean by freeze, I have an asset, a piece of property in my estate, say that's worth $10 million. And I know this thing's going to appreciate. I would like to get that appreciation out of my estate. And I want to do that, but I don't want to give up control, and I do want to retain the income from that property, but I want to get it out of my estate, all that appreciation. I may even want to get the property out. So we use something called a sale to an intentionally grantor trust. So what is an intentional grantor trust? It's an irrevocable trust that is effective. It's because it's irrevocable. When I make a gift to that trust, all of the assets that I gift to the trust and that trust acquires are not included in my estate at my death. So typical irrevocable trust outside my estate. However, for income tax purposes, it's though the trust doesn't exist. And that's a difficult concept, so it's effective. And why that is because we have an income tax system within the Internal Revenue Code. We have an estate and gift tax system. And they meet, but they don't always interrelate well. And so with this intentional grantor trust is a technique we use that sort of takes that seam where the income tax and the estate and gift tax don't quite match up. So it gives us the ability to take advantage of that disconnectedness between the two. Now again, the Obama administration is proposing that we do away with this. So again, wait for the midterm elections, we'll see what happens after that. But right now, this is a technique that's proven and has been used for quite a few years because of that seam or that gap between the two tax systems. So in this case, in this example, we have an owner, they have an LLC, and let's say that they have their real estate in an LLC. We could do this just with the real estate alone, doesn't really matter. So the first step is for our owner to set up an intentional grantor trust. So it's an irrevocable trust, sets up the son and the daughter in my example as beneficiaries. So they're the beneficiaries of the trust. And so then the owner then, we have to make a small contribution to that trust in order for the trust to be effective. It's called seed money or a seed contribution. So now the trust is viable. It's got some money in it. Trust is operating, and it just has this little bit of money. So now the trust enters into a contract with our taxpayer to purchase this property from the taxpayer. Fair market value, we get an appraisal, it's all substantiated. So that's a promissory note that is now held by our taxpayer. That pegs the value of that land. So it's, say, $10 million of land. We now have a $10 million note. The $10 million property is in the trust, and as it appreciates in value, goes to 10 million, 11 million, 12 million. All of that appreciation is not included in our taxpayer's estate anymore for tax purposes because, remember, the trust is irrevocable. It's effective for estate and gift tax purposes to get that property out. So what about the gain on the sale of that property? So assume the basis is low. So our taxpayer has now just sold it. Well, remember that the trust doesn't exist for the income tax law. So you can't sell a property to yourself and recognize gain. And that's effectively what's happened. Even though it's a separate entity, a valid entity under Colorado law, separate and apart from the taxpayer, for income tax purposes, the two are the same. So there is no tax event on the sale of the property. That promissory note, we've just swapped out a note for the property, no gain or loss on the transaction, no recognition of income. Now, if our taxpayer dies at that point, then what's included in their estate? Promissory note. And that's the value of that property at the time of the transaction. So now moving forward through the years, the trust is making payments on that note. That note is being reduced. And if this thing plays out the way we want it to, that note is retired, the property is outside the estate, and then the owner, whatever they've done with the payments on the note, may or may not be in their estate. And we can employ that. And let's just say we take that money and we turn around and do a GRAT, put that money in, shift it to the kids, and so we're continuing to move things out And so we could effectively move that property out and the note and have it totally out of the estate at the death of the taxpayer. We've avoided the 40% estate tax on that amount. And by the way, on the trust itself, who wrote the terms of that trust and what it provides? Our client did. So they've set it up so that it protects the property in that trust from the creditors of our client, because they have not retained an interest in it. They've also protected the property in that trust from the creditors of the son and the daughter, who are the beneficiaries, and also from divorce court. So if their marriage ends in a divorce, the children don't own the property, but who does? The trust. They just have the use and benefit of that property and perhaps the cash flow from it. But because they don't own it, it's not available to their creditors. So we can build in that. And if we're really in a larger estate, which we would be in this context, we may want to build in generation skipping provisions in this trust, which means it doesn't skip the son and daughter generationally, provides a benefit for them, but is not included in their estate at their death, and then goes to the grandchildren, and there's no estate tax between the children's level and the grandchildren, and depending on the amount, we could set this trust out to the side, and it would stay out of the estate tax system for generations. By the way, the Obama administration is attacking that as well, and so they're going to limit those to 90 years. Do you know how long we can set up a trust in Colorado in that situation? 1,000 years. So what were you doing 1,000 years ago? So plenty of time we can do that. So, I mean, there's lots of variance and flexibility that we have here. So what we want to do when we're looking at this strategy, we want to look at a taxpayer that really wants to freeze that value of that property, so or peg it. And we're not incurring any tax in doing that. They want to move any appreciation in that property off their ledger onto their children's ledger or into the trust, and move that appreciation out or avoid that appreciation. They don't want an income tax in this transaction on their so-called sale, but they want to retain the income. So that's an ideal candidate for this technique. And just summing up the benefits, we can sell the property to the trust, no income tax. It's removed from our estate as the taxpayer, and we get the cash flow from the note. It's protected from our creditors and our children's creditors. Now, is that note protected? No, not in and of itself. So a creditor could attach that because the taxpayer owns it. And the other part that I think escapes a number of people, because the transaction is ignored for income tax purposes, the property itself, any income generated on that, shows up on the taxpayer's return. So to put it into some context, let's say the property generates in, let's just say, rent income, $50,000 a year, but the note payment is $40,000 a year. The taxpayer is going to recognize $50,000 of rental income. They're going to have to pay tax on it, not the $40,000 they receive under the note, but the $50,000, because it doesn't exist. That transaction didn't happen for income tax purposes. And a lot of people say, well, wait a minute, that's not good. Well, I would suggest it is good, because the taxpayer is by paying the tax, it doesn't reduce the money that's in the trust. Remember, the taxpayer has $10+ million of assets, and we're trying to reduce that down. If they pay the income tax on the earnings of this property, the earnings are over here. So effectively, they're making a gift to the trust, as though the trust were then going to pay the tax with the gift, but they've made a tax-free gift. Doesn't affect their annual exclusion, doesn't affect their $5.25 million or their $10.5 million that they moved to it. So it's a tax-free gift, and that's supported by the IRS in a public revenue ruling. They say that's fine, you can do that. So it's just another way to move property out of our wealthy taxpayer to the next generation as we do that. So when we're looking at planning in this context, what we're looking at is the income tax planning. For the vast majority of us, 99.7% of us, we're looking at the income tax, managing that, no spikes in income. From those who are over that amount, we're doing the income tax planning, but we're also trying to look at the estate tax and move value out of the estate, retain income control of that through the use of these trusts, and therefore we can manage the property so that we don't have the spike in income and we don't have the 40% estate tax. So those are the two approaches to the new era of estate planning and wealth transfer planning. So with that, I'm going to invite Jennifer and Brett up to the podium. Jennifer, I met a number of years ago involved in a nasty probate litigation. We were in Denver and we had probably 10 of the leading estate planning attorneys in the state in the room, along with their clients. It's a rather large room. Most people would have been intimidated by that. Jennifer, smooth as glass, went through that whole thing. People were pounding on the table, and she was just absolutely amazing. That was my first contact with her. I was very impressed and said, I've got to join that firm at someday. And fortunately, she was willing to allow me to do that, and so I'm very grateful for that. And Jennifer is a wonderful litigator in probate and commercial transaction. Brett is also in the litigation part of our practice and does the commercial real estate litigation. Both of them are very accomplished. I have had less experience with Brett so far, but I expect that as I refer clients to him, which I do on a regular basis, my clients that are in need of that service, they're doing a great job, and would like for you to welcome them to the podium. Thank you.